Investors, welcome to the Fincards weekly deep dive. Right now, space is completely dominating the news cycle. Artemis 2 is orbiting the moon right now. SpaceX has reportedly filed for a confidential IPO targeting over $2 trillion in valuation. And retail investors are experiencing massive FOMO. Everyone wants in on the space trade right now. But here's the problem. SpaceX is private. You can't buy it yet. So where does that capital flow go until the IPO, which is supposedly happening in June 2026? Well, we want to look for a pure play, a company that is focused mostly on space and that business. And so if we look around the market, there are a few options, but the main clear one right now that's actually reporting revenue and consistently launching spaceflight vehicles would be RocketLab. So today we are looking at RocketLab. The ticker is RKLB. We're going to open up the 10K. We're going to read through the earnings release, cross-reference the space economy report that the ESA has put out, and build both the bull and the bear case with the hard data. Before we look at a single number, we need to understand what RocketLab actually is, because most people still have an outdated picture of this company. Now, if you think that RocketLab is just a small rocket launch company, then you might be about 3 years behind. RocketLab has two distinct business segments, and understanding both of them is critical to the investment thesis. So if we look at the business section of their recent 10K or annual report, we can get a pretty clear understanding before we even look at the financials of what this business actually is. So of those two segments, the first is the launch services. This is the rockets. Their workhorse vehicle is the Electron. It's a small launch vehicle that can carry payloads up to 300 kilograms to low Earth orbit. So since its first launch in 2017, Electron has completed over 80 successful missions and deployed over 200 spacecraft. In 2025, Electron was the second most frequently launched orbital rocket in the world. Only SpaceX launched more. See, this is what we mean by a pure play comparison to SpaceX. Especially pre-IPO, RocketLab is the exposure to the space economy right now, at least for the launch business. RocketLab also has what's called HASTE, H-A-S-T-E, which is a suborbital variant of Electron used specifically for hypersonic weapons testing. This is for the Department of War, previously the Department of Defense. They also own and operate their own private launch complex in New Zealand with 2 launch pads that can support up to 120 launches per year, plus pads at NASA's Wallops facility in Virginia. And the second segment is space systems. This is the part that most people are probably sleeping on. They aren't just a launch business. Through a series of strategic acquisitions over the past few years, RocketLab has actually built itself into a vertically integrated spacecraft manufacturer. Now I'm going to walk through what they actually make now, because this list surprised me when I was reading the 10K. They make carbon composite structures, reaction wheels, which are the motor-driven flywheels that now control how a spacecraft points in space, star trackers, the optical sensors that determine where a spacecraft is by looking at the stars, solar cells and solar arrays that their own filings describe as among the highest performing in the world, separation systems that release spacecraft from rockets in orbit, flight and ground software for commanding spacecraft, and electro-optical and infrared sensor payloads for national security missions. And lastly, high voltage space-grade batteries. So here's why all that matters. A customer can walk into RocketLab and get the rocket, the satellite, and the ground services, and the on-orbit operations all from just one company. That kind of vertical integration creates stickier customer relationships and higher margins over time. And if you look at the revenue mix, you can see that this idea is actually working. In 2025, product revenues, which is primarily space systems hardware, hit $372 million. Revenues from services, which is primarily launch services and engineering, were $230 million. So a total of $602 million. And they keep going deeper. In early 2026, they closed 2 more acquisitions: optical support, a leader in high precision optical instruments, and precision components, which is expanding their high volume manufacturing capabilities. Now, every quarter, more critical manufacturing is coming in-house, and this seems to be a good sign, at least for the bull case. So now that you know the business, let's zoom out and try to understand the macro environment that they're operating in, because this is where the tailwinds become very hard to ignore. Space is no longer about just science and exploration or science fiction. Space is now a primary theater of defense, and the numbers are there to back it up. According to the ESA's 2025 Space Economy Report, global institutional space budgets hit a record 122 billion euros in 2024. That's a 9% increase over 2023 and a 9% compound annual growth rate over the past 5 years. But the critical number inside of that is this: defense spending on space has now outpaced civil spending for the 3rd year in a row. In 2024, defense spending accounted for roughly 54% of total global space budgets. 5 years ago, it was 45%. So the shift is accelerating. The US is dominating in this space. America accounts for 61% of global institutional space spending, with China at a 2nd place at 15% and growing fast. Europe is at 10% and actually trending down. Now here's where it gets directly relevant to Rocket Lab. The current administration has proposed more than doubling the Space Force budget to over $71 billion. That's a $40 billion increase in a single year, and roughly $31 billion of that is targeted at what's called the Global Dome Program, which is a space-based missile defense architecture designed to track and intercept hypersonic weapons. And Space Force leadership has said they need those capabilities delivered in 2 to 3 years versus the traditional time period of 5 to 7 years. And that actually completely changes the procurement landscape for the Defense Department. The Pentagon has to buy from companies that are already in production, that already have flight heritage, and that can actually deliver hardware on an accelerated timeline. Not companies that are still on a PowerPoint slide and still trying to raise seed funding to actually launch one rocket. And besides SpaceX, Rocket Lab checks these boxes. In 2025, they launched 3 of those HASTE hypersonic test missions for the Department of War. They were awarded an $816 million prime contract from the Space Development Agency to build 18 missile defense spacecraft. And they were selected for the Missile Defense Agency's SHIELD program, which positions them to compete for future contracts totaling up to $115 billion. The broader investment landscape is actually telling the same story. Private space investment hit a record $12.4 billion in 2025, up 48% from the prior year. The number of satellites launched for defense customers has nearly quadrupled in 5 years. And satellite manufacturing orders from defense customers hit upwards of $8 billion in 2024, up 72% year over year. And defense orders now represent 67% of all global satellite manufacturing orders. In 2021, the number was 13%. So this is not a cycle, this is a structural shift in how the world is thinking about space, and Rocket Lab is positioned right in the middle of it. So the tailwinds are real, but how is the actual business performing? Let's pull up the Fincards data to take a look. Revenue, $244.6 million in 2023, up to $601.8 million in 2025. That's 38% year-over-year growth from 23 to 25, and Q4 2025 was a record itself. Q4 2025, $180 million in revenue was recorded, and forward guidance is even more aggressive for the rest of the year and next year. They're guiding Q1 2026 to be $185 to $200 million in revenue. At the midpoint of that range, that's 57% year-over-year growth compared to last year's Q1. Next is margin expansion. This is where you can actually see the vertical integration strategy paying off in real time. GAAP gross margins went from roughly 21% in 2023 to 34.4% for the full year 2025. It's impressive improvement, and non-GAAP gross margin was nearly 40% for the full year. And they're guiding Q1 2026 non-GAAP gross margins around the same. So when you see margins expanding like that while revenue is also growing, that tells you two things. One, they're getting better at manufacturing and driving operational efficiencies. Two, the business mix is shifting toward higher margin space systems work. And that's the flywheel that they've tried to create, and it seems to be working. Next is the backlog. This is the future revenue pipeline. It grew 73% year over year to a record $1.85 billion by the end of 2025. That's more than 3 years of revenue at 2025 run rates. They signed more than 30 new launch contracts in 2025, spanning U.S. national defense, commercial constellations, and new customers. We also have the launches to talk about, 21 Electron missions in 2025, 100% success rate, which is a new annual record for them. Their cash position is really impressive, $829 million in cash and equivalents at year end, plus $270 million in marketable securities. They have over $1 billion in liquidity. Now, there is something to flag here. A big reason the cash position looks that strong is because rocketlab actually raised $1.1 billion through at-the-money equity offerings in 2025. That is issuing new stock. So they have a lot of cash, yes, but existing shareholders were actually diluted just to get to that cash position. Weighted shares outstanding actually went from just under 500 million to almost 550 million in 2025. And this is expected to be about 605 million once the Q1 2026 numbers come in. So they continue to add shares, so this could be dilutive potentially. Okay, so we get it. The growth story, strong. The numbers are legitimately impressive. They're SpaceX's probably primary number one competitor for the low Earth orbit and smaller launch business. But now, here's where we try to earn our keep on this channel, because every deep dive requires us to read the fine print. We went through the 10K and we saw the risks that they have outlined there, and we think there's a couple that you should know. Risk number one is the Neutron delay. Rocket Lab's ability to compete directly with SpaceX for medium lift launches, constellation deployments, and ultimately human spaceflight all depends on their new launch vehicle, the Neutron. This is their new rocket that will carry approximately 13,000 kilograms to low Earth orbit in its reusable configuration. That's a massive step up from the Electron's current 300 kilograms. So Neutron is the vehicle that unlocks the really big revenue per launch opportunities. Now, in January 2026, their stage 1 tank actually ruptured during a hydrostatic pressure trial. That is a significant setback. It officially pushed Neutron's maiden launch back to Q4 2026. Now, they have hit other milestones along the line in the Neutron's development. They successfully qualified what's called the Hungry Hippo fairing, the thrust structure, and are moving through interstage qualification. But the tank is the backbone of the vehicle, so until they fix it and pass testing, Neutron doesn't get to fly. And every quarter that Neutron is delayed is a quarter they can't access that medium lift market, and cash will continue to burn as they do development. Now, risk number two is what they've listed as customer concentration. The 10K lays this out plainly. For the year ending in 2025, Rocket Lab's top 5 customers accounted for 49% of their revenue. Even more concerning, those top 5 customers represent 77% of their total backlog. So if something goes wrong with those 5 customers, that's 77% of their future revenue pipeline being put at risk. Now, a lot of that is the US government, so the credit risk is actually low that the government pulls out of their contracts. But they can be canceled, modified, or defunded. And the 10K explicitly calls out the risk that the US government has been aggressively pursuing cost reduction policies and elimination of programs. A government shutdown back in October 2025 actually caused delays in contracts being awarded and payments being provided to Rocket Lab. So we'll have to see where that goes, but in my opinion, with the focus on the Artemis launches recently, it seems like there's a higher quality contracts being awarded to the space industry right now. Moving on to the third risk, this would be fixed price contract risk. Approximately 47% of 2025 revenue came from the US government, as we mentioned. This is up from 33% in 2024. And almost all of this work is under fixed price contracts. So the 10K is warning that under these terms, Rocket Lab bears the entire risk of loss if costs increase. So if supply chains get tight, if materials get more expensive, those cost overruns eat directly into the gross margins that we were just celebrating. And speaking of costs, the 10K specifically calls out that beginning in April 2025, they observed a significant shift in US trade policy with the increased tariffs. They have operations in New Zealand and Canada that support their domestic businesses, but retaliatory tariffs or increased import costs on materials and components could add cost pressures to a business that's already operating on the fixed price terms with the government that we mentioned. Risk number 4 is they are still losing money. Rocket Lab posted a net loss of $198 million in 2025. That follows a $190 million loss in 2024 and a $183 million loss in 2023. Cash used in operations was $166 million in 2025, and they aggressively spend on R&D, think the Neutron development. So their R&D expenses increased by about $100 million in 2025. And the path towards profitability runs through Neutron succeeding. Continued margin expansion on the space systems and on operational leverage on the launch side. So all plausible outcomes, but none of them are guaranteed. And risk number 5 is key person risk. This one is actually pretty interesting to see in a corporate filing. We actually saw one like this when we were doing our Tesla deep dive. Tesla has a key person risk for Elon Musk, but for a different reason than Rocket Lab. Tesla's key man risk was about whether or not Elon may get stretched too thin across all the businesses that he runs. Whereas for Rocket Lab, the 10K explicitly states that the company is highly dependent on its CEO, Sir Peter Beck. Specifically, the risks with Beck are that he participates in high-risk activities such as recreational aviation, motorsports, and operating heavy machinery, all of which carry the risk of serious injury or death. Peter Beck is the visionary behind this company. He is the reason they have executed at this level. In fact, he was hands-on in building these rockets at the beginning of Rocket Lab's life. And even before that, he was obsessed with rockets. But investors should at least be aware that this risk exists and that the company itself thought it was worth flagging in their annual report. So what's the takeaway? Rocket Lab is right now the only viable publicly traded pure play on the space economy. This positioning could make them a natural beneficiary for possible SpaceX IPO hype that dominates the news cycle over the next several months. So we'll just have to add that into the bull case that they're going to get some benefit possibly from the SpaceX IPO. And talking more about the financials, the revenue growth at 38% is real. The margin expansion from 21 to 34% over 2 years is real. The $1.85 billion backlog is real. The defense tailwinds with a potential $71 billion Space Force budget are real. But so are the risks. Neutron needs to fly. The customer base needs to diversify. The cash burn just simply needs to slow. And the company is still years away from being consistently profitable. So here's how I'd frame the question. If Neutron gets the launch pad on schedule in Q4 2026 and defense spending continues to accelerate, the growth trajectory from here is significant. If Neutron has more setbacks or if government funding priorities shift, you're holding a stock that's priced for a lot of things going right. In fact, it's probably priced to perfection right now. So the data is all here. Make your own call. If you want to track Rocket Lab's margin expansion and backlog growth yourself over the next few quarters and years, download the Fincards app. It's the best place to start your stock research and track financials of companies because it's laid out right there. You don't have to dig through filings or dig through different pages on any variety of apps. It's the best place to start your research. And of course, the link is in the description like usual or on the fincards.com website. You can also search Fincards or Fincards Stock Research on the Apple App Store to download from there. If you're still here at the end, hit the like button, hit subscribe, join our community, and let me know in the comments whether you think Rocket Lab is a buy or a sell and what you think the future of the space industry looks like. There will also be a pinned comment down below on what stock you think we should do a deep dive on next. I'd love to get your feedback, and it helps us curate the content to what you want to see. And with that, I will see you next week for another deep dive, and hopefully on Friday for our weekly This Week in Markets update on the previous week of trading. With that, I will see you later.